The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho and these are your headlines today. Wall Street posts its worst day since 2020, wiping out $2.5 trillion in market value as President Trump's trade war raises fears of a U.S. recession. Top Wall Street names raise the prospect of worsening global economic fallout if Trump's new tariff slate is implemented without exemptions. But the president says he is open to deals.
Those tariffs have come in and every country's called us. That's the beauty of what we do. We put ourselves in the driver's seat. The tariffs give us great power to negotiate. Always have.
And tariffs are top of the agenda in Europe's boardrooms. Here in Chernobyl at the European House Ambrosetti Forum, the CEO Valerio De Molli tells me that retaliation would be the wrong thing to do.
That's tariffs.
They export know-how, competence, service, information technology, sophisticated software, military, tools, and we need all of it. So it would be stupid to put tariffs on what we need.
We'll discuss more with Mohammed Al-Arian, the Chief Economic Advisor at Allianz at 7 British Summer Time.
Meanwhile, crude crumbles as OPEC Plus surprises the market and boosts production, speeding up the pace of scheduled hikes and pushing prices lower. Trump often uses the word huge, and we certainly saw a huge reaction on markets to tariffs yesterday, really ratcheting up the fears about the type of economic performance we could be seeing stateside, whether it's a recession we're now on course for in reaction to these border taxes. And as a result, huge swing lower on the Dow, down 1,679 points. So well over that 1,000-point barrier that typically signifies that there's something massive moving on markets. So down to the tune of close to 4%. The S&P 500 down 4.8%. And you can see the NASDAQ, the tech-heavy index shedding close to 6%. So they're selling just ramping up in session. If you want hard and fast numbers, stocks losing roughly $3.1 trillion in market value. This is the biggest one-day decline since March 2020. And as we bring out 2020, of course, we're talking COVID-style sell-off here. Of course, during the pandemic, it was a slightly bigger sell-off that we witnessed. But by performance yesterday, it did take us into a very steep drop on the back of what was already a market that had been reeling from the potential of tariffs. So from a lower foothold is where we slipped even further yesterday. Let's dive into some of the worst performers on markets yesterday. You saw the likes of Nike, again, goods companies. This is where investors concentrated some of the selling action. Big high price performers, momentum names, they were hit aggressively. The likes of Nvidia shedding 7+%, and banks. The prospect now of an economic slowdown stateside very much hitting the banking sector. If you saw the performance in the banks themselves, big steep fall. Financials down 5%, but the bank index itself, the KBE, was down to the tune of 9%. US technology names, let's just hone in on some of those names. It was Apple that investors took stock of, the fact that we might be talking about very high-end devices now if the parts, the manufacturing has to revert back to the United States. You can see Apple stock down to the tune of 9%. AI names, they were by no means resilient. The picks and shovel space, I mentioned Nvidia, down 7%. Microsoft still down a fairly mighty 2%, and Tesla also in reverse. European markets, this has been the safe haven trade, so to speak, but I don't think there were many safe havens out there yesterday. The index levels were resetting lower as a result of what the prospects look for the global economy. The DAX and the Italian market for me have been the standout markets here in Europe. Both of those are also moving lower to the tune of 3% odd. The FTSE more contained but still down about 1.5%. And now if you take stock of German names for the trading week, down to the tune of about 3.3%. Steeper falls off the French market for the trading week, down 4%. So even with big fiscal packages here in Europe, the fact that we're now talking about a slower economic picture that is hitting all names across the board. And we were talking about gold. We saw yesterday that the market was selling what it had to sell to raise some funds. And I think same story. Don't forget a lot of the European markets. If you talk about defense, it's been up triple digits so far in some quarters. I think investors just taking stock of areas where they can sell at this point. To some of the Asian markets, Japanese stocks today down heavily. We're seeing them wear the brunt of some of that selling to the tune of 4+%. Again, some of those bank names. We're now seeing the market there, the lowest levels since August. Sharpest weekly drop in about 5 years. But again, across the board, and JP will walk us through some of those names. Asian automakers in particular, they are suffering from the prospect of facing borders every way they turn. The Toyota trade, it is down 6% plus. Nissan, these levels very similar, 7% coming off the board. Keep in mind, we have had a long runway to think about the prospect of the so-called Liberation Day, as Trump has been naming it. So markets had an ability to position, but I don't think anybody quite expected the extent of these tariffs without carve-outs. So on that vein, let me get out to JP Ong, who joins us now from Singapore with that Asia market action. JP, it is the worst case scenario that markets have been reacting to.
Yes, you are right there, Karen. And as you mentioned, the reeling continues in Asia this Friday, and the sell-off also extends. I want to bring up the Nikkei 225 since you started off with that, falling quite precipitously in today's session. Also on the back of BOJ Governor Kazuo Ueda saying that indeed the tariffs might hit the Japanese economy for the worst, thus also sending a lot of these stocks falling. 3,361 is the level you want to look at because it is coming very close to bear market territory. 33,216. That is the level where you will have it 20% below its below its 12-month highs actually. But you can see just how dangerously close we're coming to bear market territory out in Japan, and how precipitous and how drastic that sell-off has been. You take a look at what Governor Ueda actually said a while ago, and you're seeing it also have an impact in the bond space with yields continue to decline actually, and it's now created a lot of uncertainty as to what the Bank of Japan will do, because if it does lead to a slowdown or even a recession, heaven forbid, in Japan, it might actually keep them from actually hiking rates. And that's also one of the reasons why you're seeing the banks today plunging in Japan, because of the uncertainty with regards to the direction of where rates are going and monetary policy is going out in Japan. The Topix Bank Index falling by about 11.5% in today's session. Of course, out in South Korea, we do have to also taking note also of the political news with President Yoon Suk-yeol now officially ousted, with the court upholding his impeachment, and he has now been forced to leave office after that attempt to declare martial law a couple of months ago. The cost be down by about 1.9% in today's session, but you're also seeing some of these tech heavyweights in South Korea continue to sell off. Now, it's important to note that China, Hong Kong, and Taiwan are offline today because of the Qingming or the tomb sweeping holiday, so they will be spared the sell-off this Friday. But when you look across the rest of Asia, it's also looking equally punishing at the moment. The ASX 200 getting hit also. Energy stocks there falling in lockstep with that decline in oil after OPEC and friends raised output. We also have gold prices coming down also, and thus also weighing in gold miners that are listed out in Sydney. And also across Southeast Asia, you're also seeing a decline. The Straits Times Index falling by 2.9% after Deputy Prime Minister Gan Kim-yong said this could impact and might have caused them to cut their GDP growth forecast for the city-state. The Thai set falling deeper into bear market territory at 1,129 points. The VNI Index is worth looking at also today because it's extending these losses. And just to put into context here, Karen, they have gone from being the best performing stock index in Southeast Asia year to date to correction territory, all in the span of about 3 days. And that's how drastic it is. And of course, that's what happens when you have a 46% tariff hit on your levy on your country by the United States, also raising a lot of consternation about the direction of one of the fastest growing economies in Southeast Asia. I'll leave it there, but right now we're ready to phone it in out here in Asia after it's been a very punishing and forgettable week. Ladies, good morning.
It is like watching a car crash in slow motion on some of these markets today, isn't it? JP, thank you so much for the roundup. President Trump says he is open to negotiating his latest sweep of tariffs with other countries. However, that was less than an hour after his top aide, Peter Navarro, told CNBC the tariffs were not open to discussion.
If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff? The tariffs give us great power to negotiate. Always have. I've used them very well in the first administration, as you saw, but now we're taking it to a whole new level because it's a worldwide situation. And it's very exciting to see.
Trump himself thinks this is going well. I don't think markets would agree. Let's get to Alex Morris, President and CIO of FM Investments. Alex, you encapsulate this well about the economic picture that investors reacted very violently to yesterday about being fixated on inflation first up from tariffs. But that was not the broader picture as we saw markets repositioning around a severe downturn from here.
No, I think you're right. And things are going very well, according to President Trump, which leads me to really question what was the plan if this is the expected outcome, or perhaps better than expected one. And investors are left wondering, what was I liberated from today other than gains in my portfolio I'd enjoyed and what seemed like a modestly, at least for the time being, stable outlook as to where inflation and other numbers were coming and things the Federal Reserve had been working on stabilizing for years post-COVID. That now seems to have all gone out the window. And you would not be alone if you're wondering what's going to happen tomorrow. I think that's probably also true of the administration, actually.
You wonder if anyone made money yesterday or whether it was just all minimizing some of the downside. Let me get to the recession outlook, because we were talking yesterday that Goldman Sachs had a 35% expectation of a US recession. That was sort of risk they were pricing in. A crossover at JP Morgan yesterday, the analysts raised that forecast to a likelihood of recession to about 60% since the tariffs were announced. What do you think the economic fallout is likely to be?
Although I think probably a little ruddier than some, it is clear that we need to price in a recession. And now we have to get into the semantics of recession, depression, how long, how.
I'm just going to pick up there. We seem to have lost Alex, but it was the use of that D word, I think, that will be quite shocking. And we mentioned it yesterday in reference to some of the border taxes that we were seeing. And we had some analysis suggesting this is the highest border taxes, actually exceeding the 1933 levels. And that was the Depression era comparison, and whether we see some sort of response to what has been a policy of trade liberalization from the United States at the forefront of this globalization trade, to see such a sharp reversal and what economic consequences that has. Of course, we mentioned that clarity was something that many were hoping for from the so-called Liberation Day, but we don't have that clarity. And we just played a clip before where Trump was talking about this being a potential point of negotiation, a sort of a launch pad. But the reality is we had pushback from the rest of the administration saying that was not the case. So I think we just genuinely do not have any clarity at this point. And as we know, markets do not like uncertainty. That on top of the fears they're already now pricing in around a recession. And I don't think we're quite at depression levels just yet in terms of market pricing. But recession is certainly a real prospect at this stage. Let's push on to what we've heard out of Trump. President Trump's reciprocal tariffs policy has opened up divisions on what America's place should be in the global economy. CNBC's Rick Santelli and Steve Leisman juked it out on air about Trump's vision for the U.S.
We're the consumers of the world, okay? If people want to make stuff and they don't want to sell it to us, woe be to them.
I'm confused, because if people make a decision to buy something from abroad, isn't that part of the freedom and independence people have?
They don't make that decision.
Things?
They make the decision to buy what's cheap. And that's the problem. Okay?
That's
We're
a
going to
problem.
make it so it's not artificially cheap anymore. Every day, Kmart low prices had a dark side for the American economy.
No, but here's my question, Rick. What about all of the folks in China and India and other places who've been buying Nikes? Who've been buying Starbucks, who've been going to McDonald's.
Okay, why does Nike sell a pair of gym shoes for $200 and they have to make it in China where they pay people peanuts? It doesn't make sense from the get-go.
Wait, now you care about Chinese workers, Rick?
Build them over here. Okay?
Now you care about the Chinese worker.
We have people that make more money. We have benefits. We cost more to make stuff. But there's a reason for that.
Because people bring they buy something cheap and they have money to buy other things. That's how it works, Rick, over time. You want us to go back to the horse and buggy?
And that's why Trump's reversing it, because we have $37 trillion worth of how it works.
I'm confused, Rick. Is your problem the deficit or is your problem the trade deficit?
It's not easy to confuse. If we didn't have trade surpluses and we didn't have a Fed that left rates at zero, maybe the pain of overspending would have hit home much sooner.
Rick, if you don't have the trade deficit, then you won't, and everything gets manufactured here, you're not going to collect the revenue that you want, I think, from those tariffs.
I think Trump would be happy with that.
There are a lot of big debates about the fallout here. Apple was one of them. There was a note put out from Rosenblatt Securities saying a high-end iPhone could cost nearly $2,300 if Apple passes the costs on to consumers based on their projections. I mean, $2,300 for an iPhone. I think that hits home as we talk about inflation expectations and what the consumer could be facing down the track if manufacturing is pulled back to the United States, or if some of these increased costs are simply just passed on to consumers. One of the other big reactions has been in the dollar, and some are saying, is it truly going to be the reserve currency? There's been a real test now to that notion. A lot of international investors have parked money into the United States. It is a safe haven. It is a place where they know they're going to get their capital back. There is now a response saying, is it a trusted partner? And as a result, you've seen some consequences in dollar index in the past 24 hours. Other currencies have been supported. Dollar index has been on the back foot and down 0.5% again morning session. But you have seen it rattled 1.3% fall yesterday, lowest level since October. So again, a bit of a sign of the unease that is out there in global markets and whether this is truly the best place for investors to park their assets. Well, Wall Street's biggest asset managers and private capital firms were among the hardest hit stocks in Thursday's sell-off. The likes of Apollo, KKR and Blackstone all suffered heavy declines, some even double digit. This as investors revise down their growth forecasts and consider a potential dearth in deal making and credit. Wasn't this meant to be the big year for M&A? Well, it feels as though that has now disappeared very rapidly. Apollo chief economist Torsten Slok has told CNBC the impact of the tariffs will be evident on corporate balance sheets for the foreseeable future.
The conclusion is that consumer sentiment has been weakening, corporate sentiment has been weakening, and now over the next several quarters, the most important thing that Navarro just said is that there is no negotiation. And if that is true, then we should plan that this will have negative implications for earnings for the S&P 500, again, especially for the Magnificent Seven over the next several quarters. So this does indeed raise the likelihood of a recession.
Well, let's see what lies ahead today for the Friday session. After a steep sell-off, sometimes you can get a bounce, but that is simply not the case today. The selling expected to roll on again for the Friday session. As you can see, the Dow seen down more than 300 points at this hour. After a historic week for American markets, attention turns to today's jobs figure, the first major data release of the quarter. Traders are expecting a downtick in March's non-farm payrolls figure to 140,000 from 151 in February. But options markets are reportedly already pricing in moves of up to 1.4% in either direction for the S&P in the event of a surprise. This will be the last jobs report based on a pre-tariff world, so the real recessionary fireworks may still be in store. As high-frequency economics Carl Weinberg and Mary Chen write, beware April. Meanwhile, investors will get the chance to hear from Fed Chair Jerome Powell for the first time since the tariff announcement today, with his speech due just before 4:30 London time. And of course, we've been hearing some announcements already about layoffs. So the forward-looking statements from businesses, Stellantis, for instance, said it would temporarily lay off US workers, also closing plants in Canada and Mexico. So this is something the market's going to pay close attention to. Jeremy Stretch has joined us, Chief International Strategist, FICC, of Fixed Strategy at CIBC. Thank you so much for joining us today. Well, it is certainly a volatile market at this point, and I want to come straight to the dollar questions that are now lingering in markets, because Deutsche put out a report saying we're becoming increasingly concerned the dollar is at risk of a broader confidence crisis. Do you agree?
Well, I think there are certainly concerns in that regard. I think international investors had obviously parked money in the US. They had assumed that the US economic exceptionalism, which has really been the dominant theme over recent years, had still a little bit further to run, but we had been thinking that conclusion had been reached. But clearly, investors have been reorientating, reweighting their capital flows, and the equity market has obviously been reflecting that in terms of the first quarter, where we saw obviously that underperformance in the US and relative outperformance in Europe. And so I think investors are recognizing and realizing that the presumption of just parking money in the US and that would gain good returns is now certainly under threat, or at least it being questioned.
How far could this trade go? Because we've seen in recent weeks almost a dress rehearsal on equity markets where everybody was pretty much overweight the United States and they didn't see any other real game in town. And then obviously Europe came to the party with big fiscal packages and that money has moved very quickly. Is this the same story we're talking about in the dollar? The undercurrent here could be very strong.
To an extent, yes. So if you're looking at sort of the aggregated sort of positioning in terms of the majors relative to the dollar, we've seen a substantial repricing or reallocation of asset flows away from the dollar over the course of the last 2 months. So we've seen those sort of aggregated holdings cut by almost 90% over that period. We're not yet necessarily net short, but we are on the verge of doing that. We're heading in that direction on an overall basis. And clearly there could be further to go. Now, we amended our forecast at CNBC for this quarter for euro dollar up to 110 at the beginning of the year. Well, unfortunately, we've already hit our Q2 target in the first day of the quarter. That's a problem because in a sense, I think it just underlines the pace or the scale of the move. And we're now starting to see clients talking about 119, 120 in terms of potential trading position. So it is a potential trend that has further to run if this sort of uncertainty, which has obviously been unleashed by the tariff dynamics this week, continues to oscillate around markets.
What is different about this time is that typically in times of uncertainty or any prospect of a weaker economic climate, then the dollar is the all-weather currency. It becomes the safe haven of choice. That is simply just not happening this time round. The beneficiaries, Japanese yen?
Indeed. So if you look at what we've been seeing in the treasury space, we've seen significant rallies in treasuries, reductions in yields. So treasury JGB spreads are moving quite significantly. Japanese investors, who obviously have been looking at returns elsewhere, I think will start to bring capital home. So clearly currencies like the yen, I think, will prove to be a net beneficiary. So we will see the yen strengthen quite significantly. That, of course, then causes problems for the BOJ in terms of their own attempts to alleviate the inflation dynamics.
Term premium, a rise in that, what investors demand to hold US treasuries. Is it coming? Because I was talking to someone in leverage finance yesterday about the prospect here, because we're all seeing at this point, well, a weaker economy suggests that we're going to have lower yields from here. That may not necessarily be the case if the market demands more for US assets.
There's a possibility. So that may be something which we increasingly question. So obviously, when you think about Scott Bessent, he was talking about trying to get long end yields back to that 3% handle. Well, it looked as though the US were at least going to achieve that aim as we've moved through the course of the last few sessions. But the question could be that if investors are concerned regarding the underlying dynamics in the US, then perhaps they could demand a little bit more in terms of that term premium. We don't get that sort of move lower in terms of yields that the US administration have been effectively aiming for.
Let's just contextualize what we're talking about here for the broader economy and in terms of the Trump measures. I mean, it feels like a very old market we've stepped into. The one we've had in previous years has been a market going up, there's been a lot of risk appetite, any sense of a market sell-off, it was a buy the dip moment. It feels like this has taken us right back decades to very old markets that are unpredictable, volatile, and if you step in, it's that to catch the falling knife type of narrative.
Well, certainly it's very difficult to rationalise and to buy this dip that we've seen over the course of yesterday. So people were talking yesterday not about Liberation Day but Liquidation Day, because clearly investors have been taking money out of the market. I think Warren Buffett obviously did that earlier in the year where he was liquidating capital. So there were some who were mindful of some of the risks, and clearly the tariff dynamics appear to have been even worse than most people are assuming. We're now left to debate whether there will be room for negotiation or not. And I was fascinated with your previous guest just as he used the D word, his line dropped out. So the conspiracy theorist in me will suggest that somebody pulled the line because the D word was mentioned.
Well, no one wants to hear the D word. I mean, the R word, recession word, is bad enough, let alone depression.
Indeed, but as you say, if you look at the effective tariff rates, then those are above the sort of levels that we were seeing in the 1930s. So if you go back to the beginning of the 20th century to look at the effective tariff levels, and that wasn't exactly a particularly persuasive economic period either. So in a sense, if we do sort of extrapolate these tariffs over a period and we start to talk about retaliation, then clearly the global growth trajectory will be revised down, and that creates uncertainty. And then, of course, investors will then retreat to what they perceive to be safe havens, and that seems to be less dynamic in terms of the dollar from previous episodes of uncertainty.
Yeah, it was terrific work from Simon French yesterday as he was putting out those numbers around these depression-style tariffs, the percentage levels. But what happens from here? Because Trump himself has just given some glimmer of hope that perhaps this is a starting point for negotiations. How quickly does he need to get going on those negotiations before we do see this appetite, negative appetite for anything risk assets lingering on markets? And we know when you go into that sort of direction, the spiral can get worse and worse. So how quickly does he need to act?
Time is short. So of course, I think we have the tariffs going on the 5th, and then we have the next round on the 9th. So there is a little bit of wiggle room in terms of the second deadline, but not a great deal. But clearly there is going to be uncertainty. Scott Bessender's talking about escalate to de-escalate. He's talked about caps. So there is some hope that there may be room for negotiation, but of course the administration seems to be talking with two voices sometimes on this dynamic, and that just adds to the uncertainty in terms of the broader picture.
Best trading option at this point, because I heard cash is not going to cut it because inflation might be coming back, and people are selling gold, which is a safe haven trade. What's the best trading idea at this point?
Well, as I say, I think it's looking in the FX space is looking for safe havens, and so inevitably that probably implies that the yen is going to be the port of least storm in the current environment. So I think the Japanese yen is probably going to continue to see gains.
Jeremy, thank you very much for joining us. Jeremy Stretch with us, Chief International Strategist at Fixed Strategy, CIBC. Fitch Ratings has downgraded China's sovereign debt amid concerns over public finances and the impact of high US tariffs on exports. The ratings agency said the cut was based on forecasts made before US President Trump's additional 34% levy on Chinese goods was announced on Wednesday. China's finance ministry called the move biased and said the economy remains resilient with great potential. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com. Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.